Let's talk about the markets in 2 minutes. And I want to go back to some of the overnight commentary we've had coming through from the Fed, because we've readjusted our thinking about how many cuts we get quite substantially since the start of the year, of course. But now we have quite a lot of divergence at the Fed about how many cuts we're going to get. Some saying 1, some saying 3. Your thinking on the latest Bostic versus Goolsbee narrative?
Well, I think there are 2 main takeaways. One is Powell was clearly laying the path for dissension when he finally cuts. You could tell that by his comments last week that he was already preparing the market for the idea that when they eventually cut, there may not be consensus. And that shows the kind of strength of dissension out there, or the kind of divergence, as you say, between the policy members out there. It is interesting, though, that Powell himself is clearly absolutely adamant in a very, very dovish message. Now, that's been the macro backdrop since December. It was reiterated at the March meeting to an extent that we couldn't probably expect so explicitly. This idea that, hey, growth is really good, growth's not collapsing, and yet we are still desperate to cut rates. And that is just a wonderful macro backdrop, and therefore it remains very supportive for risk assets. I do think that divergence will remain in focus the next couple of months, and ultimately, I think it's those who are saying fewer cuts, that will win out. But at the moment, it's Powell's dovish message that's winning the day.
OK, and I wonder where this takes us on the curve. We haven't talked about the inverted curve. We've just become really used to it, I suppose. We haven't talked about it for a little while. And yet we've spent a record number of days with this curve inversion between the 2s and the 10s. Where do you think that takes us, Mark?
I'm confused. Look, I'm one of those people who thinks the curve inversion is still a very important signal, because it actually has a real economic impact as on the economy. It's basically disincentivizing long-term investment in a kind of way. So it's therefore should be a brake on the economy, but it's not working as rapidly as before. Has the signal broken? Probably not. So I still think this will ultimately be a worry, but it's not yet close to the disinversion that really matters.